All right, excited to have Arthur Shalamov on today. A very close friend and amazing loan officer with All Western Mortgage. Art, we've been working together for 8 years now.
Something like that. It's been a while.
It's been a good ride. It's been a great ride, and we've always really, practiced the amazing level of service and providing an experience for clients, no matter what type of market we're in. And the main reason we're together today is we want to provide the consumers, all those buyers out there that used to have an option to get a jumbo loan for their home purchase. Now that jumbo loan is not available, but you have some options to assist buyers in today's marketplace still buy $1 million homes, primarily that 600,000 plus home with just 10% down. I mean, that's what a lot of clients are asking both of us. Are they still able to do that? So thank you for being on to provide the real deal of what's going on and what options are actually available.
Right, absolutely. And one of the things that we do, we not only provide great service, but we like to find solutions, right, to fit the borrower's needs. So personally, I always like putting deals together and structuring them in a way where it makes sense and it would benefit the buyer. So wanted to share my screen and discuss some options for that higher end buyer, if you will. I call this presentation, if you will, how to buy a $1 million home with 10% down. Let's start with a hypothetical example. Let's say we have a buyer looking to buy a $650,000 house. Let's say it's in Desert Ridge, right? And they have $60,000 for a down payment, which is 10% of the purchase price. So they would be borrowing $585,000, and that would be considered a jumbo loan amount. And let's say that's all he really has, right around $65,000, maybe $70,000 to work with. And so what would be a solution for him? Ultimately, we know that jumbo financing is any loan amount, any single loan amount that's over $510,400, it's considered a jumbo loan amount. Now, these types of products, they're a little more restrictive. Why? Because it is a bigger loan amount given to a single borrower, so they're considered higher risk. Therefore, they're going to have stricter requirements as far as qualifying. So the one requirement as of right now is 20% down payment, which is absolutely required. They just decreased or increased the down payment requirements from 10% to 20%. They also like to see higher credit scores. So minimum of 720 credit scores. Not only the score, but they also pay real close attention to the actual history and the length of trade lines on somebody's credit profile. They also have strict income requirements and lower and stricter DTI requirements. And DTI stands for debt to income ratio. So they would actually have higher income requirements compared to conventional financing. And in addition to that, a typical jumbo loan would require anywhere from 6 to 12 months in reserves. So they're looking for that savvy borrower that's seasoned with higher FICOs and bigger loan amounts. So obviously our borrower that was looking to buy a home with 10% down would not be eligible for something like this because first of all, he's short on the funds for the down payment. He's also short on reserves. So the solution as of right now would be this. You can actually split the loan amount into two. So remember how we said any single loan amount over $510,000? Well, if you're putting 10% down, your total loan amount that you'd be borrowing would be $571. But if you split that loan amount into two, so your first would be at $508,000, which is below the 510 mark. And then you would have a second behind it as a $63,500, giving you a total of $571,500, which is after the 10% that you put down. The beautiful thing about this is that when you're not going jumbo, what you're doing is you're actually following conventional guidelines, and conventional guidelines are a little bit more lenient than on a jumbo product, and it just gives you a lot more flexibility. Now, remember my initial slide said how to buy a home up to $1 million with 10%. This type of a structure would allow you to purchase a home up to $1 million with 10% down if you split and if you do a first and a second. And again, this is so as an example, your first would be at 80%, and then you would have a second at 10%, and then you would be avoiding the jumbo restrictions on this one.
So this is the workaround essentially, and this option has always been available, right? It's not a new option. It's just a solution for today's buyers that don't have 20% down.
Correct. It's been around. I've personally used it multiple times. I actually prefer that method because that second is a HELOC. It's a home equity line of credit. And the beauty about that product is, and of course there's cons and pros on every side. But what I liked about it is, especially if you have a business owner, that once you pay down that HELOC, that line of credit stays open, and therefore allowing you to tap into that equity whenever you need to.
Okay. And then another question I'm sure people are going to be asking is, the first is a fixed rate, either a 15, 20, or 30-year fixed rate option mortgage. But the HELOC, is there a fixed rate for that, or is it only a variable rate for that second?
Most of the seconds we do, they're HELOCs. And the reason for that is, and the HELOC is a home equity line of credit, and those rates are based on the prime rate, which is adjustable. So every time the Fed drops the Fed rate, then that's when you would see an effect. It would be reflected on your HELOCs. Now, the good thing as of right now is your rates on those HELOCs, your prime rate is really low. And it's, for the most part, at least for the next couple of years, we know the rates are going to stay low. So, we're expected this specific product to be, semi-attractive. And I say semi-attractive because the rates usually on the seconds are a little higher than they would be on the first. There is a fixed option available as well, but a fixed option is actually, it's amortized. Usually it's a 15-year fixed, amortized over a 15-year term, and usually gives you a much higher payment. So usually people shy away from that. Now, you and I talked about something earlier, and you're like, well, how do I figure out how to avoid, what price point can a borrower look at? So I put this for you. So let's say okay, so how much can I finance, or what price point can I be at if I want to avoid going jumbo and utilize the maximum loan amount to go conventional? So the calculation for that is you take the 510, and the actual maximum loan amount is 510, 400, but I just kind of like to use round numbers. But if you take 510, multiply by 105%, and that's used for 5% down, it'll give you the maximum loan amount of a maximum purchase price of $535,500.
And what's so important about this is it's not just for the buyers that are out there, but for the sellers, right? In today's market, sellers need to understand what the options or capabilities that buyers have. And when strategically pricing a home according to what the majority can afford or the majority can tap into when it comes to financing, because a lot of the homes are bought with financing, it's important to understand those things. So this is a perfect example of that. Thank you.
Right. So, so whenever down payments work in 5% increments for the most part. And that's absolutely, and it is important how you price your loan, because ultimately you want to know where you're at with the purchase price. If the buyer is coming in and they're thinking, okay, am I putting 5, 10, or 20%? And it gives them that threshold, because you want to avoid going jumbo, especially in today's market with a lot of volatility, a lot of restrictions. Lenders are very careful, and they double check, triple check everything. So if you can avoid going jumbo and going this route, it'll save a lot of headaches. Now, just to kind of touch base on the avoiding the headaches, if you will, the seconds are also very careful. So what's happened before COVID, the way the underwriting worked on seconds is that whatever the first mortgage approved, basically the second would follow. Now, seconds have their own overlays, meaning they have their own guidelines on top of whatever the first is doing. They may have some restrictions. So very important. So if the first mortgage will allow you to use gift funds, it is possible that the second mortgage may say we won't allow you to use gift funds or business funds. Also, there's some restrictions on the departing resident. So for example, if I'm selling a property and I'm trying to buy another one and I'm leasing out the property that I'm currently living in, there's some restrictions on that compared to what the first requires. There could also be some overlays as far as DTI. So you always want to talk to the loan officer and give them a specific scenario. Make sure the loan officer asks you a lot of questions, because these are all variables that are very important and can either make or break a deal. So you want to make sure that you're going into this, and especially if you're a realtor or a seller and you've got a pre-qual with a first and a second, make sure you actually connect with the loan officers and find out all these questions. One more thing to consider, which is very, very interesting, it doesn't necessarily has to be structured as a 80-10. It could actually be structured as a 75-15, 75-20, or even a 50-40. Sometimes when you do this, you can actually get better pricing on the first mortgage. So I've done $1 million purchase up to with 10% down, and we actually had it structured as a 50-40. Otherwise, and that's how I was able to purchase a home. Otherwise, if you want a gun jumbo, you wouldn't have qualified.
Recap of just that last part, it's very important that whoever anyone's going to be working with, they're looking at not just the first and making sure that the buyer can be qualified for just the first, but they have to really look at those overlays or those additional guidelines from the second, right? So there is a solution. So number one, the real deal here is there is a solution to still buy $1 million property with just 10% down. And to have them get in touch with you to look at their situation and making sure that they're able to qualify not just for that first, not just for that second, but for the whole package. Great information today. Really appreciate it. And until next time, thanks again.
My pleasure.
All right, over and out.